Tom Lee is bullish on stocks for the month of May following Friday's non-farm payrolls report. Tom Lee says weak jobs pulls forward the timeline for Fed cuts equals falling rates equals that aids equities. In fact, Fundstrat called it out perfectly. Deep Macro's Jeff Young sees the probability of a soft jobs report at 184,000 versus consensus of 250,000. Fundstrat said this might break the pattern of 2 steps forward, 1 step back. We expect May to turn into a buy instead of fear. The jobs number on Friday came in lower than Fundstrat expected at 175,000. But in all reality, if you strip out the 87,000 jobs that were added in healthcare and social assistance, that number would have been much lower. And it all makes sense now why Fed Jerome Powell on Wednesday was so dovish. They already knew the jobs report was going to come in light, and there is now some weakening in the labor market. To some extent, Tom Lee is correct. Some weakening may be seen as a positive for equities. But on the other hand, too much weakening turns into a huge, colossal negative for stocks. But let's be agnostic to the whole political side of this. Let's be honest. Nobody wants to see a recession, especially during an election year. And I think that's another reason why the Fed has been so dovish in 2024. You're starting to see a slowdown. Take a listen to the conference call the Starbucks had, or the interview with Starbucks CEO on CNBC. What about McDonald's CFO just saying people are not going to the restaurants as much. They're opting to eat at home. There's a lot of signs out there. People are slowing down. If they start to lose their jobs or it becomes harder to find a new job, then you have a larger slowdown and problem in the economy. So what's the bigger picture here, and what could stocks look like over the next coming months? As Tom Lee said about a week ago, he is expecting a flat to down period in the markets over this summer, which that could make a lot of sense, especially if the economy does weaken further from here. If you take a look at what the markets are pricing in for Fed policy, for the next meeting from the Fed on June 12th, there's actually an 8.5% chance of a cut, 91.6% chance of a continued pause. For the July meeting, there's a 32.5% chance of a cut and a 65.1% chance of a continued pause. The markets are pricing in the first cut now in September, on September 18th. There's a 48.8% chance of a cut and a 32.6% chance of a continued pause. There's actually a 17.4% chance of 2 rate cuts by September. And I actually believe you're going to get the first rate cut in July, probably another cut in September, and then another cut in December. So I think the markets will start to price in that cut coming July 31st, because let's be honest here, there's a lot of data coming out from now until July 31st. That's basically the start of August. Tom Lee shared this post from Jeff Weiniger on X. He says, auto insurers are crushing the S&P. I would fade this. Yes, there is more to auto insurance than the value of the car. It is really bodily injury. Okay, just in case you guys don't know, most of what you pay for in insurance is not going to cover your $30,000 car, right? That's not why insurance is priced the way that it is. Of course, full coverage covers your car, blah, blah, blah. But it's really covering you getting sued, right? If you don't have insurance, you get into a car accident, that person can sue you. If you have insurance, even like the lowest, like a PLPD, that just covers your liability if you were to get sued. So that's why premiums are priced the way they are. It says, but KBB says new car prices are near a 2-year low. Used cars down 4% from last year, and Tesla is cutting prices. Here you can see CPI motor vehicle insurance relative to CPI versus all items, and auto insurance inflation is higher than overall general inflation. That's pretty remarkable. Tom Lee also shares this post and says this is a positive, supporting lower CPI in coming months. It is a post from Connor Sen over here on X. He is a columnist for The Opinion. It says, encouraging news on the auto insurance inflation front from Allstate. Higher premiums and slowing cost growth have improved profitability, making future large premium increases less likely. Now, Fed Jerome Powell just said on Wednesday he is confident that housing inflation will start to fall as well throughout this year. Jerome Powell made it clear that market rents are really not going up at all. Actually, some markets are deflationary for market rents. But what happens is it takes a long time to get all the way into all of the data. Now, the way that the government or the Fed calculates the data is really a flawed way of doing it regardless. They're actually not looking at rents themselves. They're looking at owners' equivalent rents, asking homeowners what they think they could rent their house for. That's just a flawed way of doing it in general. But for housing inflation, that is by far the biggest segment of inflation, you're probably going to see that to some degree start to fall in the back half of this year. And I think Jerome Powell was probably correct on that. Now, if you also have auto insurance that starts to come down, well, that could be fantastic for inflation. And really, let's also make one thing clear. You don't have to see the economy get weak from here. The theory is, based on general economic practice, is if people are losing their jobs, they're not going to be able to spend as much and they're not going to be able to buy products. So companies are not going to be able to raise prices as people start to lose their jobs, which makes a lot of sense. But most of the inflation we see today is in services. And I mean, you're going to have to see a lot of people lose their jobs to not buy concert tickets or go to football games or do these activities that people love to do. So I think what you really want to see right now is not the economy weaken. Maybe a little bit is okay, but you just want to see inflation fall. And I do think in the back half of this year, inflation is probably going to continue to fall as you start to get slight weakness. The bigger problem would be for stocks is if you started to look like you were going into a recession, and that's really the bear case of 2024. If the data gets worse from here and continues to show a weakening, then the markets are not going to like that. They're going to say, oh crap, we're not just weakening, we may head into a recession. And that's where multiples can fall, earnings estimates can fall, and that's where ultimately the S&P, the NASDAQ, and the Russell, your major indexes, as well as the Dow, would also fall as well. But I do think if there was one area that will benefit from inflation falling and maybe the economy weakening a little bit, it is in your small cap stocks. Now, the earnings growth in the S&P is expected to be quite small, quite low for small cap stocks in the first half of the year. And then in the second half of the year, it's supposed to get a lot better. That's because year over year comps, if you think back to 2023, earnings were a little bit better in the small caps in the first half of the year and worse in the second half of the year. So by the second half of this year, the year over year comps for earnings are going to look pretty good for small caps. And that's another positive beneficial factor that you could see for small caps. And even on a technical basis, you are holding up higher lows. The overall bullish trend looks to be intact. Tom Lee was originally calling for a 50% rally in the Russell this year, but that was when markets were expecting the first cut in March. If the economy does stay strong and inflation falls, then I think you could still see a 20+% rally in the Russell this year. Well, as far as economic data coming next week, you don't have much on Monday. You have Fed Barkin and Fed Williams that speak around noon or so, and Fed speakers and their opinions could hold a little bit more weight right now, so keep that in mind. Fed Kashkari speaks at 11:30 a.m. on Tuesday. Consumer credit change comes out at 3 p.m. on Tuesday, and that's pretty much it. For Wednesday, some mortgage data, some oil data comes out. Fed Jefferson speaks at 11 o'clock in the morning, Fed Cook at 11:30, and a 10-year bond auction that comes out at 1 p.m. So that will be important coming on Wednesday. On Thursday, the Bank of England interest rate decision, depending on if they cut rates or not, which I believe they are expected to, that could definitely have a positive impact to our markets as well. A 30-year bond auction at 1 p.m. But that's pretty much it. On Friday, you're going to get really your only big data for next week. And that is your Michigan Consumer Sentiment Survey numbers that come out at 10 a.m. on Friday. Fed Bowman will also speak at 9 o'clock in the morning. But what you really want to watch is your inflation expectations, your 5-year and 1-year inflation expectations. So inflation expectations for the 1-year period ahead is actually expected to fall from 3.2% to 3.1%. That would be fantastic. And your 5-year inflation expectations are expected to stay right at about 3%. The bigger story for next week is going to be the slew of earnings that we are going to get. Monday, you're going to have Palantir, Lucid, Realty Income, Him and Hers, Microchip, Teradata, Axon, and Coherent. Monday and after hours, Spirit, BioNTech, Tyson, some other names pre-market as well. Tuesday after hour pre-market, Walt Disney, Celsius, Datadog, Crocs, Nikola, Ferrari, BP, and that's pretty much it. Tuesday after hours, Rivian, Arista, Upstart, Wynn, Lyft, Oxy, Twilio, and Toast. Wednesday pre-market, Uber, Shopify, Affirm, Toyota, Emerson, couple other names. Wednesday after hours, you have ARM, Robinhood, Airbnb, AMC, The Trade Desk, Beyond Meat, AppLovin, Energy Transfer, Duolingo, and Exact Science. Thursday pre-market, Roblox, Warner Bros, Plug, Sundial, Kronos, and Canadian Solar. Thursday after hours, you have Marathon Digital, you have CleanSpark, Unity, couple other names like Blink and SoundHound. And then Friday pre-market, just a bunch of random companies. So I think the bigger events this week will be earnings, especially earnings from like a Disney and a obviously ARM. ARM could be huge for NVIDIA, could be huge for the entire AI sector or chip sector of our markets. Which, to be quite honest, I'm not particularly excited about ARM earnings, so I think that could be a little problematic midweek. Let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.